Welcome. We're going to discuss international liquidity, which has become a part and parcel of management of reserves, management of liquid funds. Liquidity, on generic term, is the total amount of surplus which is available with one country, which will be made available in the form of cash when the country requires funds to be paid for imported goods and imported commodities. These commodities are required to be imported into the country because of absolute requirement of these goods and services inside the economy. So a country and its government and its administrative machinery is required to keep reserves in the liquid form so that as and when it is required it can be made available for payments. These payments are absolute must for international trade to take place, and international relations can be managed with the form of these payments. If a country defaults on its payments, it becomes sometimes just unmanageable. A prudent individual normally saves a part of his income and keep that surplus in the form of readily usable liquid assets to meet any unexpected increase in his expenditure or shortfall in his income. Similarly, country has to maintain liquid assets to maintain unforeseen fluctuations in their external payment position, which can arise either due to a shortfall in their foreign exchange earnings or an increase in imports. So, in case there is a shortfall in the foreign exchange earning of a country, it is going to utilize the reserves which it has maintained over a period of time. Similarly, if there is an sudden increase in the amount of imports because of a change in the volume of trade, then it is also required to pay in terms of foreign exchange. It's obvious that to be of internationally acceptable, it should be readily available and easily payable and should be acceptable in international standards. For meeting balance of payment deficits are called international liquidity or reserves, which are a must for each and every country to be countable in international community and keeping good international relations all over WTO and GATT principles. International liquidity refers to the resources that countries and individuals have to settle in terms of international trade. International liquidity would mean access to gold that could be used to redeem a nation's currency held by foreigners. So gold can be used for accessibility to international liquidity in international trade. It's defined in a narrow sense as well as in a broader sense. In that sense, international liquidity includes all assets and facilities that are freely and unconditionally usable by monetary authorities for the purpose of meeting balance of payment deficit. Such assets consist of holding by the monetary authorities of gold, convertible foreign exchange, and reserve position with the IMF and special drawing rights. So these assets facilitates consist holding by monetary authorities in gold and convertible foreign exchange, and also includes the special drawing rights that has been allotted to the country by International Monetary Fund under the quota system. The gold and super gold tranche of member countries with IMF are also unconditionally available for meeting BOP deficits. So when the requirement arises, it can make use of the gold and super gold tranche that is being deposited with the IMF by the country. Liquidity in the broad sense comprise of assets and facilities that are freely usable plus conditional and potential resources that are available to meet BOP deficits. So it's not only the assets that has been created in the gone by days out of the reserves which have been created from trade, plus assets like conditional assets and potential assets which can be converted as and when they are required. Suppose a guarantee held by MEGA in the World Bank, it's also going to guarantee you a potential resource which can be of large amount. Such conditional assets include credit with IMF, credit facilities extended by a foreign central bank, either under the general arrangements to borrow set up at the initiative of IMF and MEGA, and credit facilities which is extended on a bilateral basis by central banks of different countries to a particular domestic central bank. International reserves consisting of gold, convertible currencies, and gold and super gold tranches are freely usable by monetary authorities for meeting payment deficits. It's obvious from these facts that only assets which are in the possession of the monetary authorities can be considered as international reserves. So which are not in ready possession of the monetary authorities, including the central bank of a domestic country, cannot be treated as international reserves and international liquidity, because in case of requirement, they are not going to be useful in short period of time. Held by individuals are not available to monetary authorities for meeting payment deficits. So individuals using their own currencies are not going to be available for monetary authorities. In some countries where foreign exchange regulations are in force, private individuals are not allowed to own foreign balances, and all earnings of foreign exchange by residents normally should be available to the monetary authority, as such earnings are required to be surrendered to monetary authority in exchange for local currency. For example, in India, a certain kind of tax deduction is allowed to individuals as well as export oriented undertakings under section 10A, 10B and 10C, that if they deposit all the foreign exchange earnings of a particular financial year with the monetary authority, they are going to get the benefit of a tax deduction for a particular number of years in a particular percentage. So that acts as an added incentive of depositing all the reserves earned during period of trade with the monetary authorities of your country. The drawings of gold and super gold transposition, though required to be reconstituted within a period of 3 to 5 years, are reckoned as freely usable assets. So as and when they are required, even if they are deposited with IMF and World Bank, they can be drawn upon and they can be used as and when they are required. The special drawing rights, which is happening to be with monetary fund, international monetary fund, are deliberately created reserve assets which are then allocated to member countries by international monetary fund on the basis of a quota, and it can be used only to be converted in denominated foreign currencies. It cannot be converted through all the currencies, but only through some pre-specified denominated currencies. Special drawing rights held by a country are reckoned as freely usable assets, although there are some reconstitution obligations attached to the use of SDRs. So SDRs held by countries with IMF can be used as and when it is required upon, and even if there are some obligations on the part of the countries to be fulfilled, it can be used as a freely movable asset, so that it can be converted into dollars or euros or pounds as and when it is required. It can also be converted into Japanese yen if required. But what is the need of liquidity? Liquidity is required on the part of individuals, and in the same way, liquidity is required to be kept by countries. Countries import commodities from outside and export commodities to outside the world. The export commodities bring currencies, they supply currencies to the economy. But at the same time, imports bring foreign reserves into the economy. So demand and supply is created within the economy. But if imports are more, then we are required to keep reserves so that we are able to pay, we are able to honor our commitments of liability payments within a particularly stipulated period of time. Countries enjoy sovereign ratings. These sovereign ratings are very critical from international goodwill point of view. Countries must not and should not default in the payment of loan repayments and interest thereon. So that's why countries are required to keep liquidity in hand. Under the par value system, the exchange rate is maintained within the officially declared range. A buying and selling rate is maintained and around the fixed parity by official intervention by the intervention of Reserve Bank of India in the domestic foreign exchange market. The parity of the currency is fixed in terms of an intervention currency, and if foreign exchange tend to appreciate or depreciate in the domestic foreign exchange market, then the monetary authority will come forward. They will intervene in the market by either selling or buying the commodity, the foreign exchange in question, as the case may be, against the local currency. If such a situation arises, the monetary authority would sell the foreign exchange to satisfy the excess demand, and sometimes they can buy to absorb excess supply in the market. These buying and selling operations by central banks are essential for stabilizing exchange rate under the par value system. Suppose in India there is more foreign exchanges available than being demanded. So because of the availability of large number of foreign currencies in large volume and amount, the supply far outstrips the demand, and as we have already seen while doing the equilibrium rates, that the actual amount of equilibrium price can go down if supply is much greater than that of demand. So in that case, to prevent the domestic currency being appreciated, the monetary authority will intervene into the market and decide to buy foreign exchanges from the market to absorb the excess amount of supply that is available into the market, thereby almost equilibrating demand with supply, so that equilibrium price can be established. But in the case that the demand is much more and supply is not there, in a case that some year the balance of trade is positive, your exports are more, imports are less, then demand is much more. In that case, they would look to, the monetary authority would look to sell foreign exchange to increase the demand, to increase the supply rather, and meet the excess demand in the market. So instead of price going to increase, the price will again stabilize. The massive balance of payment deficit caused by the steep rise in the oil prices have added a new dimension to the problem of international reserves held by petroleum exporting countries. These countries known as OPEC. Because of they being in a market condition in which they can always going to control the supply of oil, they are in a position to fix the price. They can up the price of the oil price in the international market by limiting the production, limiting the supply. They can also take down the price by increasing the total amount of supply into the market. So as a result, they try always to limit the supply so that the countries outside the OPEC has to pay for more for oil so that more foreign exchanges can be earned. So these countries has large BOP surpluses. But at the same time, the reserves held by the rest of the world are decreasing at a very fast rate. So which means there is going to be an immediate imbalance of BOP in most countries, and the BOP deficit is increasing by the year. Unless some flexible rules are made and adopted at the earliest, the liquidity of developing economies will be severely depleted, and it will jeopardize some of these economies forever. The basic problems of international liquidity arises because of more demand than that of supply. There is a shortage of international liquidity because of BOP deficits. BOP deficits arise because of higher imports and lower exports. Most of the countries, the GDP is not growing in a percentage that is required it to grow. Under those circumstances, whatever is produced within the economy is consumed to a larger extent. Population increase in developing and least developed countries is very high. The population increase in a country like UK is 0.2 percentage for last 40 years. In case of India, it is more than 1%, which means the threat of population is more in developing countries. So because of higher population, these countries require higher amount of foreign exchange to spend. Imports are generally much more than exports. If and there is also one particular area in which these developing countries, because of high consumption of automobiles and machine equipments, are also in a position to consume large amount of oil. They don't produce oil, so because of that they have to import oil in super large containers. They have to pay large amount of reserves, and that's where the BOP deficits are coming. If you take down completely wipe out the oil bill of India, India's BOP deficit would come down by 50 to 60% each year. The second problem with international liquidity is that of high tariff barriers. The tariff barriers are very large in developing countries. It has come to be regarded as one of the largest barriers to international trade. Tariffs are large, taxes are large, thereby reducing the competitiveness of domestic market. Developed countries have a lot of attitude. They don't want to help the developing countries and LDCs to reduce the BOP deficits. They're not opening up their economies to cheap and cheaper exports from developing countries. Apart from that, for the last few years, international reserve is also the total amount of international reserve is coming to a skewed distribution because of unequal distribution of wealth, unequal endowment of factor proportions between developed and underdeveloped countries. There has been some suggestions made to solve these problems. Developing countries should reduce BOP deficit by promoting exports. Developing countries are in a position in which they are going always to be responsible to create more exports. They should ban non-essential consumer goods by selective tariffs and physical quotas. So these should not allow import of non-essential items. A developing country should devalue its currency so as to reduce the export price and raise import price with a view to on foreign exchange, because people, when they're looked upon that imports are much more dearer than exports, they will be looking at exporting and producing themselves rather than importing from an outside country. A developing country should follow restrictive monetary and fiscal policy so that it is able to reduce domestic demand for products, to reduce import price, and to check inflationary pressure. Developed countries should reduce their BOP surplus, which means accepting national currencies of developing countries for payments. Because what we see generally that United States of America doesn't receive rupees. Rupee is a strong currency if you compare that with that of some African and Asian countries. So removal of trade barriers is also required apart from receiving currencies from developing countries. Trade barrier is very important because by opening up the trade route, you can create new export frontiers. More commodities from smaller countries should be allowed to enter the developed countries, accepting the products of developing countries in exchange. So, like America, United States of America actually enjoys and gives a particular kind of sugar quota to protect its sugar producing farmers. So it gives subsidies to the farmers working in the United States because they produce it dearer. But it doesn't allow farmers from outside of United States to go and trade their commodities in United States at the current price. Suppose say 1 ton of sugar is produced in United States of America for $45. 1 ton of sugar is produced in Egypt for $33. So these sugars are going to be exported from Egypt to United States. It's much cheaper. But to protect the sugarcane growing farmers in United States extends some kind of subsidies. So it subsidizes the United States farmers by rupees $10 per ton. That reduces the United States prices from 45 to 35. If you add the international transportation cost, when sugar from Egypt reaches United States, it finds that its sugar is slightly dearer than United States sugar, even if originally it was meant to be cheaper. So because of that, the Egypt sugar, even if it is of good quality, it becomes dearer, non-productive, non-competitive in US market. So thereby, the planned expansion of trade fails very miserably. At the same time, IMF should also look forward to expand the international reserves by fresh allocation of new quotas to members and new issue of SDRs to be distributed to developing countries. So means there is a requirement in the IMF, both in the IMF and World Bank, that the quotas of rich countries should be reduced and the reduction in favor of should be done in favor of developing and least developed countries. That is when more power will be transferred from these developed countries, a few number of developed countries, to developing and least developed countries. The components of international liquidity is gold and foreign currencies held by monetary authority. It is the primary form of international liquidity. At the same time, the borrowing facilities available from IMF and World Bank is also one form of international liquidity. Special drawing rights granted by IMF to its member countries so that special drawing rights can be converted into denominated currencies at the time of requirement also serves as liquidity in the long run. Borrowing capacity of the country, borrowing capacity of a particular country in international market is also one form of international liquidity. So when a domestic country is in need of funds, it can borrow from international market at a very low rate of interest. But the borrowing capacity depends upon the credit rating, the sovereign rating. If the sovereign rating is good, the policy formulation in the domestic country is good, its GDP growth is good, industrial production is also going to be good from expected quarters, then each country can be given large amount of borrowing capacity in international market. That will create long-term liquidity in favor of these countries. Now we are coming to discuss India's reserves. During early 90s, the reserves were highly inadequate even for importing essential commodities. It was so concerned, it was so bad that in the early 90s it was like only 4,000 something crores. So as a result, with the advice of IMF and World Bank, India started a liberalization policy. After liberalization, the Indian reserve started increasing. To maintain public confidence in the capacity of a country to honor its international obligations is the chief objective of international liquidity. To increase the capacity of monetary authority to intervene in the foreign exchange market is also one of the requirements for holding international liquidity. Liquidity helps you go through different phases. Likewise, in the last 3 years, a severe recession gripped the whole of the world. Lots of developing nations were in firm grip of recession, but China and India were not that much affected because of its consumption power. Because of high amount of population, these countries still generated large amount of demand even if the price was high. So some of the largest sectors did not come under the grip of recession because of higher demand. So that's the essence of holding reserves, that when required you can use those reserves to fill the gap between the requirement of export and the actual larger requirement of import payments. Some countries will have liquid surplus, whereas some will be liquid deficit, which means some countries with balance of payment positive, GDP growing to a larger extent, will have liquid surplus, like that of India, China. But some countries will be in a liquidity deficit, like Pakistan experienced the same format 5 years ago. It was on the verge of being insolvent. It could not pay the repayments of International Monetary Fund's loans for 3 months. So if international reserves do not grow as fast as international trade, it will result in a global shortage of liquidity, thereby affecting large number of countries. The current India international reserves as on November 25, 2011, total reserves stood at 15,079,000 crores. Out of that, foreign currency assets was 14 lakh 10,000 crores, gold 1 lakh 31,000 crores, and SDRs at 23,422 crores. Reserve position in the IMF was around 14,000 crores, which means it increased from previous weeks. So which means if you convert that into US million dollars, you can see that there has been some kind of changes over the period of time from end March 2011, from end December 2010 till November 25, 2011. So there is positive changes in India's foreign exchange reserves. These reserves helps us balancing and bringing equilibrium to foreign exchange rates also. With the reserves increasing, we can expect that the foreign exchange rate of dollar to rupees to dollar can actually go on to stabilize and not fluctuate as violently as it is doing now. The countries with largest reserves of foreign exchange and gold, headed by China. China's large amount of reserves. India stands at the 8th position, below Japan, Russia, Saudi Arabia, Taiwan, Korea, and Brazil. We have of course not taken into account the developed economies. Japan, in spite of being a small country, is actually enjoying the benefits. In current account deficit, the foreign exchange reserve should be equal to at least 3 months of imports. This measure is more useful in situations where capital flow are strictly controlled. This is import adequacy, which means if primarily a country is import prevalent, which means imports are more than exports, then any country must have a foreign reserve which equals to 3 months of imports of that country. In large volume of debt servicing, it is recommended that payment liabilities, in addition to imports, be taken into account while determining level of reserves. So it means debt servicing should be good. A country has taken large amount of debt. Always a country will have large amount of debt. Every year it has to service the debt, it has to pay the repayments, it has to pay the interest. So these must be taken into consideration to create debt adequacy. In volatility of capital flows, reserve adequacy can be measured in terms of ratio of short-term debt and portfolio of stock of reserves. In case of reverse capital flow, the monetary authority will be in a position to prevent a precipitous depreciation of exchange rate. So which means there is enough reserves of capital within the country and which is in reinvestable form. Another measure of reserve adequacy is net foreign exchange assets to current ratio. This should prevent unwarranted expansion of currency and ensure remedial measures are put into place long before a balance of payment deficit reach a crisis level. So monetary adequacy must be maintained for foreign exchange reserves. The alternative indicators of reserve adequacy is structural aspects of balance of payment, nature of stocks, degree of flexibility in exchange rate regime, its access to international capital market. The more open an economy and greater variability of its trade, the greater is the need of reserves. Which means an open economy, there will be a lot of variations. In one month, imports will be more than exports. In the other month, exports will be more. So greater variability allows the need for more reserves. The main benefit of holding reserves is that it helps in preventing external crises related to the currency and related to payment aspects. And last, the sterilization process. Sterilization is the process of neutralizing additional money supply in the economy. If you have additional money supply, what it does is it creates more supply and less demand. The central bank of a country in that situation buys or sells foreign currency in order to set the temporary mismatch between foreign currency and domestic currency. Such intervention will affect the money supply in the economy. The purchase of foreign currency by the central bank in the open market will have a squeezing impact on money supply, which in turn will have its own implication for price stability and financial stability. So which means in case of supply, the Reserve Bank, central bank is going to purchase the external and external currencies which are available within the economy in surplus quantity, so that supply almost becomes equal to demand. And in case of inadequacy of foreign exchange, unavailability of adequate amount of foreign exchange in the market, it will supply from its own reserves to the market, so that more supply makes it almost equal to demand, so that equilibrium exchange rate can be maintained. Countries always going to maintain liquid assets to maintain and meet unforeseen circumstances. These external payment positions, either favorable or unfavorable, will happen either due to a shortfall in the foreign exchange, earnings, or increase in imports. As I have already told, that assets maintained by countries for meeting BOP deficits are called international liquidity or reserves. These reserves are of greater importance to an economy from a stability point of view. The reserves must be maintained for monetary adequacy, capital adequacy, and reserve adequacy measures. Enough for today. We'll meet with a new session. Till then, thank you very much.